Firstly, thanks everybody for coming to listen to me today. I'm just been introduced as CEO of Condor Gold. I'll get on with the presentation. This first slide is giving a number of messages. Firstly, that we own all the land, that the project is fully permitted. We have 2.4 million ounces of gold in Nicaragua. We have all the permits to clear the site, so we've done some of that here. We've now cleared 14 hectares for the site preparation. And this is where the processing plant is going to be, and our base case is 100,000 ounces of gold a year. This is our statutory disclaimer. And so Minalandia, we completed a feasibility study, a bankable feasibility study last October, which is filed on CDAR, and a copy is on our website as well. And out of the reserve case, we're 82,000 ounces of gold a year out of a single pit of about 900,000 ounces at 3 grams. The upfront capital cost for that is $106 million. The feasibility study is a document that's accurate to 10 to 15% of accuracy, and it's only out of reserves. We have 2 other permitted pits that can take this up to 100 to 120,000 ounces of gold a year. And the upside scenario is that we can get to 150,000 ounces of gold per annum by adding in our underground ounces. We also believe we're on a major gold district with an additional 5 to 10 million ounces of land that we've picked up. In terms of our break-even prices, the AISC, that's all-in sustaining cash costs, it's under $1,000 an ounce, or less than half the current gold price, and undervalued, and we'll come on to that in a moment. So we're in Nicaragua. This is in Central America. The government is very, very supportive of mining. Most things are being permitted at the moment. Gold's the biggest export. You own 100%, and I've been working there for 15 years. This is the project. We picked up a very large area of 587 square kilometers. I started off with 22, and we picked up all these additional concessions, so 12 in total. And our internal study shows there's possible potential for an extra 10 million ounces on this. So that's why we get excited. And I'll come on to why that is the case shortly. This is the latest mineral resource, mineral reserve. We put this out last year. And there are, if you count around here, there are 7 different deposits. There are 3 core gold deposits, which if I just look at the south, we've got La India vein set, that's 1.3 million ounces in total and has a reserve. If we go to the middle, on the America vein set, we've just got under 500,000 ounces. We go to the north, it's Mestiza. So there's your 2.1 million ounces of gold. And the black areas are the fully permitted areas. So that's the polygon that the government gives us. And these outlying areas, like Cacao, there's another 100,000 ounces of gold here. That's 4 kilometers away. All this can be expanded by drilling down the ore shoots or along strike. This is a slightly different order of slides. I put this in because we've had Jim Mellon just giving his keynote speech. And Jim is actually chairman of the company and a 20% shareholder in Condor. We have 2 other institutional investors there, and as CEO, I also retain 2.5% of the company. And I thought I'd just talk through some of the valuations that we have. Why am I mentioning this? Because we've announced that the assets of the company are for sale. So really, for anybody here, your investment decision is, can we sell the assets of the company for more than the current market capitalization? It's basically as simple as that. So in gold companies, there are 2 principal ways to value a gold company. And bear in mind, this is pre-construction, and it's shovel ready, it's construction ready, it can be built in 18 months' time, and it's fully permitted with everything there. And I'll show all that in a moment. But just looking to the value, at 30p, which was the share price when I wrote this, close to 32p last night, the market capitalization is 54 million sterling or 67 million US dollars. The valuation of an ounce in the ground, this takes, that valuation matrix is based on taking 2.5 million ounces. Why 2.5? I've added the silver credits in and 100,000 for the Rio Luna, additional concessions we have. So we have 2.5 million ounces of gold equivalent in Nicaragua. And we can then take the market capitalization and divide that into the 2.5 million, then you end up for each ounce of gold in the ground that we have is $27 an ounce in the ground. So, or you can buy an ounce of gold for $2,000 an ounce, roughly, or $2,030 an ounce last night. So we're valued at 1.3% of today's gold price. That's one way to look at it. Now, projects tend to sell between 3 to 8% of the gold price in the ground. The problem with this valuation matrix is it gives nothing for permits, buying land, buying mills, and upside potential, but which we have all of those things. The other way is on a net present value basis, and this is a proper NPV, I'd call it. It's after the upfront capital cost, and it's after tax. It's a net conservative present value. So based on our PEA, and these are independent numbers, and these numbers are already in the public domain, but assuming we can get to the 150,000 ounce production per annum, today's NPV is $418, and the IRR is 54% at $1,700. And so our price to book value, which is the ratio between your market capitalization and your net assets, is only 0.16 times. So it's a big haul, an 84% discount to asset value. And similarly, if we go to today's gold price of 2,000, we're 90% discount to the net present value. So the investment decision is, can we sell it for more than this? And we think we're incredibly cheap at the moment. I'm going to whiz through this because I've spent a bit of time going through valuations, but I hope that's helpful for retail investors here. So this is the permitted area. Everything within the magenta or purple polygon is fully permitted. This goes for the processing plant. Now I'm moving the camera, but the big pit here, that's 1.2 kilometers long, 500 meters wide. We truck the ounces, 1 million tons per annum to the processing plant, take the gold out, the waste goes into tailings storage facility. This has taken years to get done, and it's fully permitted to construct and operate, and that's the master permit, the environmental permit in Nicaragua. There's 16 different studies, and we've had a great team doing this. This is the feasibility study. The reserves are on the single pit, so that's just zooming in on what I've just shown you. And this is the feasibility study. So this is the bankable study. Why did we do this? Only on 40% of our ounces of gold. Because this is the study to which the banks will lend on, and it's plus or minus 10 to 15% accuracy on the upfront capital cost, and it's about 15% engineered. So it's a really, and this costs $7 million to do. So the tailing storage facility study costs $1.2 million. The metallurgy studies cost $700,000. They're big studies, and it's very sensitive to the gold price. I just highlight something. If we had an EBITDA out of a single pit, we get an EBITDA of 355 million at 1,700 ounce of gold. And if the current gold price, you add $200 million US onto your EBITDA over the period. So it's highly sensitive to higher gold prices. This is a comparison between the economics of the single pit to feasibility and the upside scenario. So the single pit is 82,000 ounces of gold a year on this line, and the upside scenario is 150,000. It's just giving you some of the matrix, and hence our NPVs and so forth to come through from this. This is the processing plant layout. This is 50% engineered. It's shovel ready, and if you had the money, you can build this in 18 months. And we bought all this land. So the way it works, I've just got a moment to show you. The open pits over there, 2,500 tons a day goes to what's a primary crusher, and then it goes to a ball mill, and it gets ground down to sand, to 75 micron ground size, and that's the whole layout of a processing plant facility. Very accurate. Here's the mill. We bought a SAG mill, including getting it into Nicaragua. It cost about $7 million, including transportation. And that's in the country. That's your long lead item, so it's good to go. The government and community have been delighted to see that. This is a cross-section of the main pit. It's just showing you some very, very high grades for the pit. You can read those off. The upside, we're looking to get a valuation when we exit on the company for the additional ounces. And we'll just talk to this. We've got two major regional. So here's the permitted area of Landia, America, Mestiza, and we've got these major regional faults. And we know this because we've flown it with helicopter-borne geophysics, we've flown it with magnetic surveys, we've done soil geochemistry and so forth. And this looks like a very prolific gold district. This is what some of the majors want to see. And if we drill down those ore shoots, we think we can go in the core permitted area of 2.1 million, we can increase that to 3 million ounces of gold. The other areas, the other four small ones, we think Cacao in particular can be another 1 million ounces. This, for example, is just some of that exploration upside. I can just point, if I use my hand, this green area is the open pit, the India open pit, the one that's got the reserves and 900,000 ounces in. And then if you go to the south of it, there's a fault, and the gold drops down 150 meters. So on the left there, you see on the surface there's nothing. There's no gold mineralization. The pit suddenly stops. And you go, why is it stopped? It's just dropped down 150 meters. We've got the super high-grade gold ounces here, and there are big intercepts over 1/3 of an ounce of gold, and the average width is 10 meters. We just need to drill down beneath these drill holes, and we're going to find more gold. There's about 100,000 meters of drilling on this, or 100 kilometers of drilling, so it's hugely drilled out. This is the best upside scenario. We've got 100,000 ounces of gold over where it says Cacao on the far left. We've traced this. The yellow is a colluvium, which is a covering of the gold vein, and the riverbeds in green, we pick up the gold, and it goes for 4 kilometers. We drilled this 12 months ago. We've got about 1,000 meters here. The blue line shows everything in the gold mineralization wider than 10 meters, which is fantastic for a gold vein. And there's one intercept of 30 meters. So we think there's another 1 million ounces. It just needs a drilling. Environmental and social, and I'm going to go on, leave a minute or two for questions. We put a huge amount in the local communities. We've got a social team of 12 people. We're training 120 people at the moment for jobs in the mine. The community's voted for a new mine. It's an old mining town with 40% poverty. The mine closed in 1956. We're giving drinking water to 450 households every week. And the message I got when I was in Nicaragua last time, when are you going to build the mine? And we've told them that we're looking to find a partner or a big gold producer who's got the cash and the mine building expertise to build the mine, and that's what we're delivering. But social license, really important. So the investment case, just to sort of wrap up here, the FS, or the feasibility of this plus or minus 10 to 50% accuracy out of a single pit, is 82,000 ounces. We've got 2 other pits permitted. That takes it to the 100 to 120,000. If we add the underground in, we get to 150,000 ounces of gold for 9 years. And there's significant upside, strong economics, and we think it's pretty undervalued at 1.3% in today's gold price for ounce in the ground. And here's some value developers, a peer group comparison. But I'll leave on that sort of summary case. And you mentioned a question, so I notice I've got just over 1.5 minutes left. If there's any questions, I'm happy to take them. We also have a stand here, so please come out to the stand if you want to ask any questions.